Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome to another episode of the What Matters podcast. I'm your host, Mike Mershazadeh.
And I'm Ashley Ward.
And today we're thrilled to have Michael Hirthler, the founder and chief investment officer of Jacobi Capital Management, join us here. With over 35 years of investment experience, Michael formed Jacobi Capital Management in 2008. By the way, what a year to start an RIA, as we all know there. And RIA out of Pittston, Pennsylvania. Jacobi is an independent firm focused on providing objective fee-based investment advice. Michael, welcome to our show today.
Thanks for having me, Mike. I appreciate it. And Ashley, thank you.
Yeah, it's fantastic to have you with us today, Mike. Let's hop right into your story. So your journey in the world of wealth management began over, or investment management, I should say, began over 35 years ago, starting in 1985 with Thompson McKinnon Securities, then to founding Jacobi Capital Management in 2008. Could you share with our listeners how your background and experiences shaped your path into the investment industry and led you to where you are today?
Sure, Ashley. Yeah, well, it's been a long time. Looking back, it seemed like yesterday. But when I was in college, I did do an internship with Merrill Lynch, actually, in Wilkes-Barre, Pennsylvania, which is Pittston, Pennsylvania's Wilkes-Barre, Scranton. So when I got out, that was in the summer of 1984. So when I got out of college in 1985, I was trying to get a job. I got licensed with an insurance company, got my Series 7, and but nobody would hire a kid. My dad and mom had 7 kids. You know, we were struggling. My dad was a painter, and we were actually painting the Thompson McKinnon office, and I was helping him out for extra money. And I had just kind of like pestered the manager there to give me a shot. And luckily for me, or unluckily, somebody quit a couple weeks later, and I kept calling him, and he gave me a seat. And back then they called it like a bullpen and a phone book. He said, I can't give you any money, like whatever type of business you get, you just have to make 100 or 200 phone calls a day. So that's what I did with Thompson McKinnon.
I said, wow. So you started off in a bullpen as well.
Yes. Yeah.
You know, I got to tell you, the bullpen is the concept of the bullpen is just, there's something so nostalgic about the bullpen and just the noise and it's almost like I feel like they don't really exist anymore. I've walked on, I have friends that have very large sales organizations, and it's like everybody's doing computer and emailing, and rarely just people are just on the phones. And I think that, for people like you and I that started off on the phones, we appreciate if somebody reaches out to us, right? Because it's just something that nobody really wants to do anymore. And I know somebody like yourself, if you had to make 100 or 200 phone calls a day, let me ask you this, at what point did you say, you know what, I'm pretty good at this. And, maybe I want to not make other people money, and maybe I want to go start my own thing. It might've been a monetary issue. It might've been, the way that you feel like you can help people out was different than the way that they were helping people out financially. What was it?
Sure. Probably from day one, it wasn't a lot of fun. But in 1989, Thompson McKinnon actually went out of business, and I was looking for an exit strategy. So they were the 4th or 5th largest wirehouse firm in the country then, 5th, I think. And that's what they called, like, those brokerage firms, wirehouses. And
And they went out of business in 1989, you said?
Yeah, pretty much like a Lehman Brothers. And Friday we went home and everything was fine. And I guess there were these new partners in there, and they made some mistakes and leveraged up some things. And I think they bought a yacht or something that got into trouble. So we came in Monday, and there was they called us brokers, and there was 12 or 13 guys. There weren't any female brokers in the office then. 5 or 6 went to across the street to Prudential-based securities, and 5 or 6 went to Dean Witter. You had to go to one of those places, and I went to Dean Witter. And from there, it was the same thing, cold calling, trying to build a book of business, getting people to buy stocks and bonds and mutual funds. So I continued to look for an exit strategy. In 1991, the end of 1991, I was reading one of the trade journals, and it had this firm, LPL Financial. You could be an independent advisor. Like I think the whole firm, there were 300 advisors when I joined around the country, and now there's like 23,000 affiliated with them.
Yeah.
And they had that corporate RIA, and I told my wife at the time I was married, I said, let me try this for 6 months. It might work better to have this structure where you go in, you act then the word fiduciary, even though it was a corporate RIA, and you build these investment models out for people and financial planning models and see if that works. Because I was kind of failing in the industry, really wasn't doing much business.
So did you maybe think that it wasn't the right industry for you at that point, or?
Oh, yeah.
Yeah.
Yeah, I was thinking about, so you had these friends then, you're 27 years old, and they're pharmaceutical reps or even commercial bankers for the local banks, and they get a company car, and they're making back then 1989, 90, 60, $70,000. They take their little kids to Disney World once a year, the Jersey Shore in the summertime. And here we're just slugging away, making a couple hundred phone calls a day. And, it was not easy.
So at what point did you say, because, I know that for myself, I never got into the RIA industry until I, got into private equity, which was this year. Prior to this, Ashley and I was in the mortgage business. Ashley's been with me for close to 7 years now. And I was in the mortgage business for a quarter of a century, right? Sold my company in 2020. And there's a lot of similarities in the businesses. One, I would say, one business is for the individuals. I'd say that maybe, didn't obtain a higher level of education. And I would say in this space, there's more polished individuals in there. I feel like there's a lot more honesty in this space too. And, had I would have learned of the wealth management space, when I was 15 and a half years old, when I started off as a telemarketer in the mortgage business, I would have chosen this path, way before. So you're saying that you got in there and you said, hey, maybe this isn't for me. At what point did things just start clicking and you're like, hey, maybe this is for me? Because, you've built a very nice firm. So something had to click at some point.
In 1994, things started working better. And I say 93, 94, and I read this lecture by Charlie Munger called Worldly Wisdom. Charlie, who just passed away last week. And he did a lecture at USC. And he talked about building out businesses and building out models. And that kind of resonated with me. And I was able to apply those principles and just become mission driven, live on those principles, and then got lucky, started getting some good clients and a little bit of a following. And from there, it wasn't until say 1998, then I thought I might have a career. Like before that, you still weren't sure if this is where you were going to stay. So from 94 to 98, those were pretty good years. And then 2000, when everything blew up, the tech bubble, burst, we had a lot of growth from 2000 to 2005 because we applied these principles and models, and then we did well with our planning and our investment management. So that helped a lot, and that's when I kind of knew this is where I wanted to stay, and it fit. It's like I think all models, it depends. Like people are wired differently, and what you have to find what works for you. And luckily, I came across that and finally found it.
Oh, cool.
Yeah, and then so how many years was that you were with LPL until you decided breaking off on your own?
Yeah, so with LPL, you're still independent. So I was with them in their corporate RIA. So it wasn't until 2008. In 2008, they'd come to me and they said, hey, we want to start this new business model called a hybrid RIA, where you become your own RIA. Remember, we were an RIA under their umbrella. And now it's this huge industry, but it's really in its infancy because I don't know how many are affiliated with LPL now, but I know we were the first, and that was 2008. So it's only like 14, 15 years old. And I don't know why they chose us. We had talked about some different things, and we were their test, and there were 5 that they started with, and I think now they have a couple hundred. So yeah, and then we had built some infrastructure. We have some really good talented people, and I think they saw that we were able to do that.
Very interesting. And so, Michael, tell us a little bit about the Jacobi Method. You've mentioned that, which forms the core of your firm's investment framework. Can you explain to our audience a little bit what this methodology entails and how it shaped the strategies at Jacobi Capital Management?
Yeah, sure. So it's so in Charlie Munger's lecture in 1994 called Elementary Worldly Wisdom, and he said you could create this lattice work of mental models, and how to make yourself a little smarter and to think through backwards. So one of the tenets of that lecture was, he said, by the way, follow the wisdom of Carl Jacobi. He was this German algebraist 200 years ago who always said, invert, think your problems through backwards. Interestingly, 2 years ago, there was a book written by one of the directors of Amazon, the original directors, and he said that Jeff Bezos started the whole company in 1998, and they had to invert every problem, like think it through backwards. Charlie Munger always says, write your obituary and live your life backwards. So when we try to marry like financial planning with investment strategies in planning, and with that, one of the principles that we always use is say, let's think this through backwards. I'm 60 years old now, and if I was going to retire, I would want to say, hopefully life expectancy is 85 or 90. Take yourself out to 85 or 90 and say, what did you do that could have screwed this up? And then try not to do those things. Because we don't know the future, it's unknowable. So we try to marry all these principles, and we have our list of principles that we follow, and we try to make sure that we articulate those to our clients.
So let me ask you this. Tell us a little bit more about Jacobi. How have you guys have grown to, I never trust everything that we read on RIA database and whatnot. You guys are about 1.5 billion of AUM. Correct me if I'm wrong there. And how have you built the company there? Have you guys built the company organically, inorganically? What are the secrets? What are the secrets to your sauce there?
Yeah, a long time. Number one, of sticking to those principles, and we're a little bit over $2 billion. I think on our ADV is like $1.9 billion. And remember, we're a hybrid, and then we have a little bit under what is called. I'm gonna have to make sure I say this correctly for the regulators, under management, under advisement, guidance, but overall, we have on our platforms a little over 2 billion. Most of the growth, Mike, has been organic. One of the things we did, we built out, I like to say this, like vertical structure. So it started out, not to sound arrogant, but I was this person building this. Remember back in the day, they called it this book of business, your clients. And I always thought, when I did start the RIA, I didn't want to make money off like coworkers and colleagues. I wanted to make money with them, and I wanted them to be able to grow. So we built this vertical structure as opposed to horizontal, where you try to, bring somebody in, bring in other advisors. I said, let's keep building our brand. Let's keep reinvesting in ourselves and our community, and stick to these principles and build it out. And so we've had this organic growth. We have currently like over 2,800, we call it family, some are institutional, but 2,800 units as clients. A couple advisors joined us that led to what we would call inorganic growth, but 80% of the assets is that organic model, that vertical model that we follow.
So were these guys, were these, I should say guys and gals that you hired straight out of, call it college, or that you took under, you didn't go hunting out of other wirehouses or other RIAs to get them. You took them and showed them from the ground up how to do this. Is that correct?
That's correct, Mike. We had a pretty robust internship program. By the way, it started when it was just me and an intern. You know what I mean? And,
wow.
And a phone receptionist too. Our first phone receptionist just retired 2 weeks ago at age 88 and a half. So we don't have much turnover. And the lady that works with her is 82 that is still here. So the we had this internship program, so we would bring in college students, and then every time we did about $250,000-300,000 of revenue, I would add somebody. And so you would add that person. I would go to an intern that we saw that kind of fit our culture and say, would you like to come try this? Now, here's what you have to do. You have to learn operations, compliance, investment management, like just go through the process that I had to learn when I started with LPL. I did the account openings and all that kind of stuff when you were, I think we had like $4 million of assets, so you really couldn't hire anybody back then in the first couple weeks, months. So through that, then we let them, I don't want to say it's not a 3, 4, 5 year program, but they take a couple years and then they come back and they say, hey, here's where I want to go. And it's really interesting. I've had people that say, Jeff Clemente, who's still here, he's been here 12 years. He's 35 now. He said, hey, he got out of St. Joe's. He was with an insurance company for a couple months. And he said, I'm going to sell and make all this money. And then I said, okay, come here and do this. And when you're ready, I'll set you free and you could build your own client base. Every year now, so any day now, he should knock on my door. But for 12 years, he comes in and he says, calls me Mikey. It's just a funny, he's like, Mikey, I'm not ready yet. Now he's gotten really interested. He built out our trading systems for the RIA and a lot of the investment management. Mary, who happens to be my daughter, she started here and she worked at Goldman Sachs for 4 years, Blackstone and for a year. And she's been here 9 years now, 10 years. She wanted to do operations. Now she loves sales and client facing stuff. So
wow.
we just allow people to kind of find their way. Like interestingly, this week we hired last week 2 people, which is the first time we went outside that system because we're, that intern system of people, but, and you get to experience them. So it's kind of, this was a real risky move for us. And we hope we got it right with these recent 2 hires, but we had to do something because we have been experiencing some more growth and, we just needed some more operations support. We have a 13-person operations team. So if you take care of the client, one of Charlie Munger's other tenets is the golden rule: do what you would want if you were on the other side of the table. And the other side is like make sure that you could service the clients just the way they need service.
So you said you have 13 people in operations. How many total employees do you guys have?
There's like 32 people, including some sales reps, but on like say the core team salary that aren't like an advisor that joined us, there's like 18 people on salary, like that have a salary wage and bonus structure, etc. Some are licensed, but a lot of those, everybody gets licensed almost. When I say operations, it's those lanes, we call them those swimming lanes: operations, investment management, trading, and everybody has to wear a couple different hats, not all the time, but know that they could cover for each other, but then go into their preferred seat and their seat that they excel at.
So you said you have about 17 or 18 total advisors now?
So let me reframe that. So advisors, there's licensed people, but not responsible for. There's probably 5 people that are responsible for building their own business.
Gotcha.
Does that make sense? I don't mean to, through the years, there'd be somebody that says, hey, Mike, we open an office outside of Philadelphia. A couple great guys that I know, they say, can we, partner up with you and not use your RA, but team up with you. And so we did that with them. And there's 1 or 2 advisors here in Wilkes-Barre that joined us from another place, and with like $30-40 million books of businesses, and we're helping them grow in there, and we're integrating them in the systems, in the Jacobi systems, if you will, and with the team and helping build out their team. If we could get a lady named April Vincerelli, young lady, middle-aged lady now, joined me 23 years ago, and she's been really key to a lot of our success. She's a chief operating officer. And I always say that's when we started experiencing like that dramatic growth. We hit those numbers where like the compounding took effect. And say if you could, let's try to just keep rinse and repeat, do this over and over again. So I probably am not going to be around 20, 30 years from now, but if you guys and gals could replicate this over the next 20, 30, that would be a dream of mine. Like that's what we're working on now. How do you keep this going for these 30, 35, 40-year olds that are working so hard, and they're really smart, and they're doing a wonderful job.
That's really cool. Then I had the last question. I know Ashley had some questions to pepper
Sure.
in there, and so I didn't mean to hog the microphone. Your business
No.
is very intriguing to me, and I got to tell you, Mike, I really love interviewing individuals that have had so much organic growth, because nowadays, Ashley and I will interview people, and they're like, "Oh yeah, we have 7 billion AUM," and then it turns out that I mean, I kid you not. And Ashley, correct me if I'm wrong here. There's this individual, name not to be mentioned, that we interviewed. He had 70 DBAs underneath his umbrella, and they managed maybe 3.5 billion. And I was like sitting there going, that seems like a lot of work, right?
Mm-hmm.
And and I think at the end of the day, one of the detrimental effects of things that can happen there is, if you got 70 DBAs, let's say that they're under Jacobi, no one's selling Jacobi, they're just selling themselves. So they're gonna be as loyal as their options on, which more like a TAMP that's going to pay them more, and they can hop around every couple of years and whatnot, right? So what I was going to ask you there is, with that type of competition in the marketplace, how have you been able to keep your culture flowing? How have you been able to keep everybody aligned with you and say, hey, listen, like, keep them away from saying, hey, we want to go to these 1099 shops, build our own business, make more money, be more entrepreneurial? How have you kept everybody underneath one umbrella there?
Yeah, so I think it's number one, when they joined us, you make sure that it's a cultural fit. By that, we developed this like NZS, non-zero sum culture, we call it, and that's from friends of mine that run a company called NZS. They're money managers, really, really great firm, and it's basically you grow by giving. So when I talk about when these people joined us, those that gave the most grew the most, and it's a small sample, like here in a small amount of people, but I could look back now over the last 10, 15 years, and those that said, hey, I want to be part of this organization, this team, and they're financially doing really, really well. But they said, hey, I'll build out this department, help build this out. And they didn't come into me every day and say, hey, you better pay me more or I'm leaving. So those that kind of clung to something like, I have this idea, but unless you force my idea on the other people in this office, like I always promise everybody safety. You're safe to come with any idea and grow, and make it so good that everybody else in the firm wants to deal with you. Like some people partner up with each other, some like advisors, and some on some cases, but I don't force them to have to, use somebody as a sales manager or something like that. So everybody's safe to kind of grow how they want to grow. And Mike, as I said, some of the things when I started this, I saw that I looked at what I wouldn't want to do. And I wouldn't want to just bring on a bunch of advisors, like you said, and have them come in and join you and say, hey, you have this big firm. And if you have advisors that are doing a good job, they're mad at you because they're paying you this override, and it's just for office rent or something, And then if you have people that aren't doing well, you're mad at them because they're not meeting their costs. So you just kind of bring people in and help nudge them along and keep buying into the culture. And it's so far we haven't had anybody want to leave, with that. If they do, that's okay. Like if we could get them to that point where somebody felt super successful and want to do something different, but I think so far they're pretty happy with it.
That's wonderful.
They're being recruited. I know that they're always coming. Their recruiting is, you're a target, right? Like
Right.
We're in a small town relatively, so you have $2 billion in a small area, like you're a target, and I get that.
Absolutely. Well, speaking of success, Michael, you've been recognized multiple times by Barron's and Forbes. What are some of those strategies or principles that you mentioned, a part of the Jacobi Method, that have been instrumental in propelling, Jacobi Capital Management to the top of where it is, over $2 billion AUM?
I think some of them is, so we went out in the late 90s when I started this. I started uh, acquiring research models. So by that, I mean subscriptions based. So I think one, for sure, we've invested a lot of capital back in, which is and I would tell anybody, if you want to grow, you have to reinvest. If you just take your revenues and um, consume them like lifestyle, that's fine, but you're going to be stuck there. And I've noticed in my career, like a lot of people, they get to that 10, 15 years and you become somebody says, oh, I'm a $500,000 producer, $1 million producer. That's fine. And it's fine if people want to, hit those numbers and be comfortable with that. But if you want to grow a firm and an organization that is bigger, than that book of business and that goes on hopefully for a long time and is multi-generational, I think you have to reinvest. So what we did is reinvest, your time, your education. Everybody here goes on, they get their CFPs, their masters in finance. We're always learning, reading. We have everybody has to read an awful lot. We're involved in the community. We've donated our time and resources, et cetera, to multiple organizations, and not just for business. That's kind of how culturally how we're wired. And I'm having a lot of fun watching the younger generation buying into that, and they're so involved and mission driven. I would say like it's important to have that mission for others, and everybody's kind of adopted that. And those that have adopted it, like I said, this giving type culture and mission have grown. It's kind of funny. Like the more you give, the more you get. That your grandma told you. Like that's so true. But I would say part of that reinvesting is in great research services. Applied Finance Group does analysis on companies' abilities, cash flows out of Chicago, companies' ability to create cash flow. Same with Holt Value. It's now owned by Credit Suisse, or whoever Credit Suisse sold to. So we've been clients of theirs since the late 90s on a macro basis. Ned Davis Research Company. We do a lot of work with them and some fellows that broke away from Ned Davis, 314 Research. So we built out all these models and we've invested the same in our financial planning systems, the e-monies plus in-house stuff. We have all these Excel whizzes that come in. We try to do custom type planning, like I said, integrating the planning with the investment strategies, and we're always tooling around with that and trying to make it better. But it's difficult. We've bringing in everything in-house and doing that. We really don't outsource too much. So because we have built these models over many years, so we just have to use them.
Right. And shifting gears a bit, what do you vision for the future of your firm?
So I would say it's continuing to reinvest. I think we're in the talent acquisition business almost, right? If that makes sense. In other words, just keep acquiring talented, high character people that believe in your culture. It doesn't mean that if somebody doesn't believe in your culture, there's not high character. I mean that just are wired that way to want to be productive givers. And back in the day, like when Mike and I were talking earlier about, 25 years ago, firms looked for people that were connected. Like if you were connected to wealth, they would hire you. Which was smart. Like they get you all your friends. Now in the digital world and information, like we're doing this podcast, so everybody could get online. You could learn so much, and the AI revolution, et cetera. So I think talent is so important. Just it's more important to be smart now than connected. Is my point. Smart and honest. Like you're going to go a lot farther than being just connected. Yeah, probably if you're connected, smart, and honest, you're really good, or you have a good future. But I think we just got to continue to cultivate the talent that we have and allow them to grow and allow them to find more people to help them.
When it comes to acquiring talent, you guys have done that, as you said, mostly organically. Had you guys, besides the couple individuals you said that you hired with $30-40 million books of business from wirehouses, had you guys ever done inorganic growth with the organization, or you kind of stayed steady with building things with organic growth and keeping the culture aligned there?
So far, just organic. Now we realize to potentially grow. Remember, we said like this vertical structure and synergies back and forth. We realize we probably have to go a little horizontal, because
Mhm.
you hit these economies of scale or these walls of scale that it's just becoming. It's like that Moore's law, right? It's just becoming more difficult to just grow vertically without bringing on talented business development people, if you call it that.
Right.
Wealth
Right.
advisors, business development.
And where do you see, where do you see the Jacobi in the next, let's say, 5 years? Where do you guys see your AUM at? Where do you see the company at that point?
hmm So we always say I've never been one much for like revenue targets because I don't know, we could just make up a number, but uh, I feel under the gun at 60 years old. I feel I have 5 years to get it right. So when you have an idea at 40 or 45 or even 50, like if you screw it up in over 5 years and don't execute on it, you have time. So I don't have that time. I hope to be here for a long, long, long time is my point. I'm not saying 5 years I'm leaving, but I think, those windows of executing on those strategies get smaller and smaller. And I think I'm driven for the next 5 years to make sure that we could continue building this culture as much as possible, if that makes sense. Like, and we're in kind of a little bit of a hyper growth mode, really not because of me, because of the next generation. So I'm just trying to make sure that I'm there for them to help guide them along. I just read this great book called From Strength to Strength, Arthur Brooks, and it talks about like as we all get in our 50s and 60s, we better start preparing for these things because otherwise you're just going to be miserable and depressed. And I don't want to be miserable and depressed.
No one does. And I mean,
hmm
to your daughter, do you see her, working at Jacobi for the long run there? She's been there for 9 years, I believe you said.
Yeah, is it 9 or 10, right around there? Yeah, I think she's just turned 35 and she's getting married finally. So I think she's in for a career now. And she's got a great group, her colleagues and all with her, like they're all in. We make sure everybody has a career path, tries to see their career path. That's so important to me. If you come here to make sure that you really understand that you're safe to pursue this career path, and you're also can be certain that we will do everything possible to make sure you achieve those goals. There's nothing that at this point in my life and always that makes me happier than seeing that.
I
So
love
so let
that.
me ask you this: when it comes to the the future of this industry, right?
hmm
And there's so many things I learn about it every single day. Yeah, I recently learned that the whole RIA concept, that if this was what 30, 40 years ago, 85% of them, 85% of individuals, and you highlighted to that point when we first started the podcast, were working under bigger wirehouses, right? Like the whole
Oh yeah.
independent family offices didn't come about until a couple decades ago. And so kudos to you for being one of the pioneers there, I should say.
hmm
And going off on your own. But leading into my next question there, we've had we've had when you had said that you had gotten in the industry, we've had so many hurdles, right? I mean, just a couple ones. We had 2008, 2020. Well, that was a interesting one. 2022, and where we've had some really big ups and really big downs. I know that you said that you started your company off in '08, which
hmm
I wanted to just curiously ask you about that. Starting off in '08 was I mean, I could tell you that was one of the most turbulent times that the US has ever even seen
Yeah.
before, right? So
hmm
you're starting off in RIA. People, I mean, there's some people that lost 80% of their portfolio. I mean, how was going to work for you? Like, how was like how was that going home and saying to your wife, "Wow, today was very interesting," you know, and propelling out of that, where did it take you?
Yeah, that was interesting. So it wasn't like we were a startup. Remember, it was just a, a little check mark that you change. You know what I mean? We changed from corporate RIA to our own. We were still
Right.
independent and had to like nobody was paying our bills. But yeah, those time periods, you get yeah, some of your rides home. It's a small, short ride home for me, but a lot's going through your mind. Back then when you said Mary, I had a daughter off. She was off in college, and how do you pay for college? And we we know now, looking back, everything always ends up okay. But then when you're in the heat of those moments, like you just don't know, and it's I guess that's why our careers that we've built in this industry, like a lot of people have done well, but there's a lot of risk. There's a lot of risk. We've been really lucky. Uh, I read this article like a couple weeks ago, or this I was on a podcast, and this fellow, I think he was one of the founders of Pixar, and he said, make yourself a big target of luck. And the way to do that, make sure you could survive. And I think it's all about survival, making sure, your personal balance sheet, your company balance sheet is able to survive those downturns, because you're going to have them no matter what, they're going to be there. So if you're around long enough, luck is going to come your way, and so make yourself a big target of that. It's a good way to think about it.
Yeah, and you mentioned a little bit earlier AI. How do you envision it transforming its role within wealth management space? I know there's been a lot of talk about it across every industry.
Yeah, that is a terrifying and exciting topic right now, with this wide range of outcomes. And we try to think of everything as this wide range of outcomes. The NZS fellows I told you about, they call it, like, they have these white papers on the markets and economies as complex adaptive systems that can't be predicted. So we always say, as opposed to predict, let's prepare. Let's prepare for this. And I was reading an article yesterday. There was a thing on CNBC, and the COO, Brad Lightcap, is the CEO of OpenAI, which is ChatGPT. Last year at this time, right before they announced the ChatGPT, and they weren't sure how they're going to announce that, but he, as the COO, estimated 1 million daily concurrent users. They're at 100 million already. So he's basically in charge of the company. When you talk about wide range of outcomes, and he said, how are we going to prepare for 1 million people hitting this app? And it's 100 million. And he goes, I guess we were wrong, right? So, but I do think, like, this digital transformation that we're going through, when you think about it, even back in the day when we said we were in a bullpen and you shared it was called a Quotron machine with the other people in the bullpen, and people called you. Our value proposition was, Ashley called up and said, hey, Mike, what is IBM trading at? And our value was, we told you where it was trading at. This is 1990, because the internet, you couldn't go online and check for stock quotes. So, we had this great business model where we had a value by giving people stock quotes, so on the other hand, we had to be on the phone all day. Now, I mean, if all of our clients called us every day, I don't know how we would operate.
Oh my God, that'd be a nightmare.
With emails, we're not text, but emails, et cetera, like the digital way of communicating, you can handle so much more business. And my guess and hope is that with artificial intelligence, those that adopt it quickly, like, we're building out these chat bot assistants, if you will, like that, for creative industries like ours. Like, at the end of the day, you guys are storytellers, right? Podcast, we're storytellers. The best story wins. The best money managers don't always win. You hope they do. Warren Buffett's a great manager, but he could articulate what he's doing. Howard Marks, the list goes on and on. If you look at, like, successful people on the money management side and planning side, they could articulate their process and story well.
Thank you. I appreciate that.
Yeah, very intriguing, Michael. Well, unfortunately, that's all the time we have for today, but it's been a pleasure having you with us. Your wealth of knowledge and experience is extremely valuable. So we really appreciate you sharing that with us and our audience. Thank you for joining us today. And to our listeners, thanks for tuning in to another episode of the What Matters podcast. Join us next time as we continue to explore the world of wealth management and uncover the strategies and the stories that leave a lasting impact. Thanks, everyone.